Hello everybody, I'm Francie from Investment Properties Global. A question that we often get from new property investors is how to calculate the tax on capital gain when they sell their investment property. Now, since I'm not licensed or have any qualifications to give you any tax advice, I actually asked Ben from AH Jackson and Co. Chartered Accountants to give us a little bit of information.
Not a problem, Francie, not a problem.
How are you doing, Ben?
Good, thank you. Very well.
Good. I want to, before we actually start talking about the capital gain, can you just introduce yourself and the company to the listeners?
Yeah, not a problem. So, my name's Ben Odgers. I'm from AH Jackson Chartered Accountants, one of the partners of the firm. The firm's been around for close to 80 years now. Obviously had different owners throughout that period. I've been with the firm for 18 years and a partner for close to 10 years.
Okay.
So, yeah.
Impressive.
Long time.
Thanks.
Yeah. So we look after a wide range of different clients, from larger corporations and business owners to smaller business owners, family groups, and in what we're going to talk about today, property investors.
Oh, because I was going to ask you, so you deal a lot with them?
We do have
Property
quite a few of our clients that own either one or multiple rental properties across their portfolio.
Because that's important to me, to refer people to an accountant that really has that experience. Can you please tell the listeners what exactly is capital gain tax?
So capital gains tax gets a little bit confusing within some taxpayers, that they think it's just a straight tax that they have to pay based on a percentage. So some people think that the capital gains tax percentage is 20% or something like that. It's actually calculated based on your marginal tax rate. So the capital gain, not the capital gains tax, but the capital gain itself is worked out by taking the sale value of the asset less the purchase price, and obviously taking into account any associated purchase costs or selling costs with regards to selling that asset.
Yes.
That works out the capital gain. From there, if that asset's been held for more than 12 months and you're an individual taxpayer, you're able to discount that gain by 50%.
Okay.
So, for example, for me, to make it easy to work out, if the capital gain is $100,000, you only have to record $50,000 of that gain in your tax return if you've held that asset for more than 12 months. Then the tax is payable on the $50,000 reportable amount at your marginal tax rate. So if someone is earning somewhere around the $80,000 to $100,000 a year mark, then the $50,000 tax would be around about 39 cents on the dollar, or 39%.
Okay. Would you be happy to just draw a little table for them,
Sure.
please? I would appreciate that.
Not a problem.
Okay, awesome.
Okay, so I believe this type of example is on the website, but we'll run through it briefly now as well. So we're looking at a purchase price on an investment property of $400,000. And we may have some capital costs, which can be things like stamp duty, legal fees on the purchase, of approximately $20,000. Meaning it's got a cost-based value of $420,000. We can look at the selling price being $500,000. And not to get too complicated, we're taking that selling price as inclusive of all selling costs and things like that, meaning we've got a capital gain of $80,000. And as you can see here, we've got the option of less than 12 months or 12 months or more, greater than 12 months. So as explained earlier, the CGT 50% exemption applies only to assets that were held for more than 12 months. So the ones that are less than 12 months, we don't get any exemption for, which brings our taxable capital gain here down to $80,000. Over here, we've got more than 12 months, therefore we're able to reduce our gain down to $40,000. We're now going to work out the tax on the taxable capital gain. So the taxable capital gain for less than 12 months is $80,000, which needs to be reported in the tax return. We're going to assume that the taxpayer is paying tax at 37%, which means the tax payable on this would be $29,600. For the option of 12 months or more, that would be $14,800. So a significant tax saving to be holding an asset for 12 months or more. That would then leave our after-tax cash profit at $50,400 here, $65,200 here, meaning we're getting an extra $14,800 in profit.
Thank you, Ben. But I just want to make something clear. This is basically on the one property.
Correct.
Obviously, if you own more properties, the amounts may vary because your tax bracket may vary, and that is where you have to speak to Ben.
Exactly. Thanks, Francie.
Well, thank you, Ben, for your time today.
Not
Really
a problem, Francie. It was good
that.
chatting with you, yeah.
Yes, I'm sure this makes it very easy for the people, for the listeners to actually understand capital gain tax and the implications of it.
Excellent, great.
If you want to know more, please just leave a comment below and I'll make sure to get you in touch with Ben.
Thank you.